Hello, and welcome to another episode of the Markets at a Glance series. My name is Rufus Kamau, Markets Analyst at FX Pesa. So today we'll be talking about the current market events, what's really moving the markets, and at the same time we'll be doing technical analysis to try and understand where the markets might be headed next. And once we cover these, hopefully you will be able to trade from an informed perspective. So as usual, I would like to begin with a disclaimer that this session is purely educational. It's not a recommendation to trade. It's not investment advice. So you should always do your own due diligence and of course, practice proper risk management. So once you join in, kindly say hi on the live comment section, and these will confirm that everything is working just fine. So as we all know, the economic calendar is about to get busy. So we have had quite a number of events. So we go through that before we look at the events ahead. So let's get started with the economic calendar. So from what we are looking at here, we know that there was the OPEC meetings over Sunday. So during the OPEC meetings, the oil producing countries agreed to extend the current oil output cuts through to next year, that is 2025. And that was expected to have a good bullish momentum, which started initially on Monday morning, but later on we had a sell-off. And so far today, oil prices are down over 5%. It has been a common reaction over time. Whenever OPEC announces output cuts, the markets have been reacting in the opposite direction. So it's nothing new in the markets. So we had the ISM manufacturing PMI from the US yesterday at 5 p.m., which came in slightly weaker than expected at 48.7, whereas manufacturing prices are also weaker than expected at 57.0, which is a leading indicator that manufacturing activity is slowing down in the US, which was also reflected in the GDP data that we saw last week. So moving forward, today we have had quite a number of events. So CPI in Switzerland came in as expected with a 0.3% month over month. And year over year, it was 1.4%, nothing much of a change. So it was the same as last month, but still the inflation is significantly below 2%, which means that the Swiss National Bank has more leeway to continue cutting interest rates. Remember, among the top economies, it was the first to cut interest rates. And now we have two central banks that are announcing interest rates decisions later in the week. So today's major event revolves around the job openings, which will be the first data point indicating the performance of the US job market. So job openings are basically reflective of future hiring or basically labor demand within an economy. So when there's more job openings, it means that there's more employers looking for employees, and as a result, it is indicative of a tightening labor market. So in the previous reading, we had 8.49 million jobs advertised, and now we're expecting a smaller number of 8.37, which means that this trend could continue, where we had a peak of about 11.51 a few months ago. That was about 2 years ago. So since then, these numbers have only been decreasing. So if we remove the forecast and clean the data, you'll notice this was the last data point, and we're expecting the number of openings to continue reducing as the job market continues to soften. So when there's a lot of companies looking for employees, the job market is considered to be very tight. But then as the number continues dropping, then the job market is considered to be at ease. So far, the US Federal Reserve has been fighting to slow down or soften the job market, because if there is higher demand for employees than the number of employees available in the economy, the resulting outcome is that companies will tend to increase salaries, increase the perks that they offer to their employees to retain them, and this creates inflation. There will be more money flowing in the system. There will be more money, more people who are employed, who have more money, who spend on more stuff, leading to increased prices within the economy. So on the opposite side of this is that if companies have to pay higher salaries, in order to earn that money to continue paying higher salaries, they have to increase their product prices, which is reflected in the inflation readings. So both scenarios are not good for what the Fed is trying to achieve, which is slow down the economy, soften the job market as well as the real estate market, and in that case, achieve the 2% target of inflation. So if we see job openings softening further, maybe to 5.37 or lower, then that would be consistent with the Fed's expectations. And we should be expecting to see a much weaker dollar. But then a big jump in job openings, let's say it jumps higher than 8.49 million, which was the previous reading, then in that case, we should be considering a potential where the dollar index starts to strengthen, or basically the dollar starts strengthening against other currencies. So that's the case scenario for today's trading at 5 p.m. That should be right after the market opens today. So later on, we'll have more news coming in. This is on Wednesday. So before tomorrow's session at 11 a.m., which is the market snapshot, we'll have Australian GDP data coming in at 4:30 a.m. So we'll be expecting to see an economic growth of 0.2% in the first quarter of this year. And this is similar to the previous quarter, which was also 0.2% growth. So you can see from the record of performances quarter over quarter. So in the last couple of quarters, what we have been seeing is a weakening Australian economy. So GDP has been dropping and getting seriously or dangerously close to zero. And with a slowing down economy, it allows the central bank to have that wiggle room to basically cut interest rates. So while the Reserve Bank of Australia has not begun cutting interest rates yet, much weaker GDP would be in support of rate cuts. And as a result, it would lead to a weakening Australian dollar. But then if we get a number that is bigger than the projected 0.2%, then that makes the job harder to cut interest rates. And as a result, we could be seeing a strong Australian dollar. So those are the key events that we are expecting towards tomorrow's session. Remember, tomorrow's session is 11 a.m. And of course, now focus will move to ADP and farm employment change and the interest rate decision by the Bank of Canada, which will be happening at 4:45 p.m. So that's not the title of today's session. The title for today's session is more inclined towards trying to understand what's currently happening with equity indices. So we have seen major US as well as European equity indices signaling a correction. And there's a lot of panic selling that has led to a big sell-off in these equities in the last 2 days. So far this week, we have seen almost all indices going down. And we'll be trying to understand what's happening and how that might play out going forward. So I'm looking at the comment section. Hello, Kigs. Thank you for joining the session. Hello, Jason. Hello, Simon Gitao. Hello, Malombe. David Nyabuto. Thank you, guys. Thank you for joining the session. I appreciate your feedback. If you have any questions, feel free to type them in the comment section as we progress, and I'll be responding as we approach the end of the presentation. So let's get to the next part. And I think this is important. So just a second. So in the month of May, we saw major equity indices making a very important and strong recovery. And I'm talking about the S&P 500, the Dow Jones, Russell 2000, the NASDAQ, all making some good record gains, all of them hitting a record high. And at the same time, we saw it happening with the European equity indices, ranging from the Euro stocks, from the France 40 index, from the Spanish IBEX, from the German DAX. All of them had a very strong momentum. And that led to a belief that we could be seeing an extended rally for the better part of the year. But then the events of the last 2 days are not very promising, and we are seeing the markets take a sharp turn backwards. So the stock market took a narrow road to record highs last month. And the key highlight of the month is that the rally was majorly driven by 6 stocks. So just 6 large tech stocks contributed more than 75% of the S&P 500 gain in May, a move reminiscent of how the Magnificent 7 tech stocks drove the stock market rally in 2023 or rather last year. So last year it was about 7 companies that drove the big rally in the top US equity indices. But now we have seen it happen last month, but even with smaller number of stocks, in this case, 6 companies, namely Apple, Alphabet, the mother company to Google, Microsoft, Amazon, Meta, and Nvidia. So we know Tesla was not performing that well. It had a big sell-off, so it wasn't among the highlights that were driving the market higher. So we are seeing a relatively narrow market, and that narrowness has been increasing recently and really driven by fewer stocks. So what this means is that out of 503 stocks in the S&P 500, only about 6 contributed about 75% of the gains, meaning that about 497 companies only contributed to about 25% of the growth, and that's not a good signal. In fact, it's a sign of danger that the contributors are very small in number, and if they stop contributing as much as they were doing in the month of May, then we should be seeing the S&P 500 taking a step backwards. So participation from the other 493 in the S&P 500 has been a feature of runs towards record highs in the last 6 months, including late 2023 and near the end of the first quarter. So in May, the S&P 500 rose about 4%, while the equal-weighted index was up less than 2%. In the first quarter of the year, the spread between these two indices was closer to 0.5%. So you can see the S&P 500 equal index up about 10.59%, whereas the weighted one was up 14.62%. So bigger companies in the S&P 500 tend to have a bigger weight. So that may explain why there's this big difference in the performance since last year. So, but since stocks bottomed out after a 5% pullback in the S&P 500 that ended in mid-April, the market has once again been all about big tech. So the Nasdaq Composite posted its best May in over 20 years, led by nearly 30% jump in Nvidia stock over the past month. So we all know that Nvidia has been the one stock supporting the market, and so far this week it has been unable to create new highs, and that's quite a signal and a worry that investors are considering, despite having these gains happening day after day. So Bank of America investment strategist Michael Harnett noted the relative price performance of the equal-weighted SP 500 against the market cap-weighted SP 500 is at its worst level since March 2009 after a rebound last year. So this narrow leadership has seen breadth, or the number of stocks advancing minus the number of stocks declining fall towards the low end of this historical range. So this basically means that there is more companies losing money than the ones gaining in terms of stock performance. And as a result, it means that the markets are becoming riskier and riskier, or the bull market is weakening further and further. And in that case, we could be considering seeing a market correction happening very soon. So let's look at the charts and try to understand what this has resulted into when you try to understand the prevailing price action. So let's begin with the dollar index. So the dollar index was pretty weak from Thursday last week, Friday. So Monday, we expected a strong bounce along this trend line. So after the market pulled back, we had some form of continuation, but the market didn't quite get to our target of 104.815. This is what we had speculated on Monday. But then we saw the market dropping, breaking the trend line and moving further downwards in the big sell-off yesterday, which managed to find some form of support based on the previous low. So you'll notice it's almost the same level that the market bounced today. So the previous low that we had seen here on the 15th of May also became the support for the dollar index. And for the better part of today, the dollar index has only been gaining in an attempt to recover from the big sell-off that started last week and extended into yesterday. So looking at equity indices, beginning with the S&P 500, from this big bounce on Friday, we expected a continuation further upwards to this resistance, but then we saw the market making a big sell-off before making a recovery towards the end of the day yesterday. And then today, further downside momentum. And now it seems like the market is now forming a pattern. And if you go to a smaller time frame, let's say the 15 minutes chart, then you can see that there's something cooking along these lines. And of course, if you look at the upper side, it's somewhere along these lines. So if I zoom out just a bit and I extend to the previous high, then it seems like the market is consolidating in a triangle, which means that we don't have an overall direction. So if you go to the 1 hour chart, this is how it looks like. So yes, we have big swings in the market, but the average or the relative price action performance is not that slanted. It's more of a sideways momentum for the S&P 500. And now if you move to a higher time frame, let's say the 4 hour chart, we just came off a very strong bullish momentum, and now it seems like the market is attempting to move further downwards. So looking at the most recent highs, so for the last 3 weeks, or call it the last 2 weeks, from this high to this high and then the high of this week, it seems more likely that the market is forming lower highs. And the low of this week versus last week then also indicates that this market is forming lower lows, which is indicative of a weakening trend. So in this case, we could be due for another market correction after we saw these happening some time back. So in the previous correction, we saw the market moving from a high of this point all the way down, which was about 6.6%, even though the proper definition of a correction is usually about 10% pullback. So in this case, after forming a new all-time high, we are seeing the market attempt to move further back downwards. And now that the market is bouncing and moving higher, it makes more sense to be looking for short selling positions if the market happens to be bouncing from this area. So if we happen to see a price action where the market hits this area and then after hitting fails to break and starts moving back downwards, then that could be an opportunity to go for a short selling position. But then you can't discount the power of the stock market. So also a bullish momentum could suffice if the market breaks this particular trend line. So US30 has been also pretty weak. So yes, we know that for the last 2 days, I would say here, from this high, this low, this is what we have been experiencing, and this can be extended all the way back. Then with this kind of experience in the markets, it basically shows that for the overall period of the last 2 or 3 days, it's just the market moving sideways. But then from a higher time frame, you're able to envision the bigger direction. So after seeing a double top formation on the Dow Jones, the market has been pulling back downwards, has not yet completed the pattern, which would imply a reversal pattern. So there's still more room for downside momentum where the market could potentially eventually get back to this neckline around that 7,599, or basically that's 7,600. So from the forward chart, this is how it looks like. So while the market is moving up for now, then the idea is to be looking for a short selling position, and that is based on evidence. So you have to be patient and look for evidence that the market is selling. So it's not yet happening, but the attempt to move higher last Friday has already been met with bearish momentum, whereas we had expected further upside momentum, which means that we could be seeing some further consolidation before the market makes a big move, and this could extend all the way to Friday when we get the non-farm payrolls, which might have the biggest impact on the US dollar pairs as well as US equity indices. So for now, if you're just trading intraday, it makes more sense to observe this area here and see whether the market will form some form of rejection. If there's some form of drop, then in that case, we might consider looking for a short selling position, but then it's not that aggressive. If you look at just yesterday's low, today's low, then if the market was to find resistance at the current price action level, the drop is not that big. Unless there was a subsequent break, then it would make more sense. So if there's a subsequent break, it would make more sense. So for the Nasdaq, which has been the most bullish for the better part of last year and this year, This is what we are experiencing. Yes, the market is forming daily highs that are getting lower and lower over time. So after the big sell-off last week, we saw the market making a strong recovery towards the end of the day on Friday. Then on Monday, we get to this trend line and it drops immediately. Then it goes back up, and today at market open, found resistance immediately, dropped, and now we have the same triangle happening across board, and our triangle is following this path here. So in this case, it's a mark of consolidation, meaning that the market is not making any major moves upwards or downwards. It's just moving sideways, and we need to adjust this to that level. And now we could be seeing the market continuing to play within this price action formation, potentially getting to this area, and then we observe this area for a particular price action break. So we could be seeing the market breaking or dropping. If it drops, we don't expect much price action, but then if it breaks, then it would be a major signal that the market is headed higher, which would signal a nice entry point after we get the decision point here. So then for European equity indices, we have had quite some good activity. So we'll be starting with the Spanish IBEX 35 index. So we had a big sell-off happening yesterday. So you'll notice that this was a major resistance area. So market had broken towards the upper side, then it dropped further back downwards yesterday, finding support at this exact price level here. And now today, in the last 3 hours, we are seeing the market make a very strong and important recovery, meaning that the bull market is still in play. So we don't have that much of a break, even though the daily chart, it's the third consecutive day that the price is attempting to go down. It seems like the price is holding on quite well. So for the big sell-off that happened yesterday and this morning, seems like the support is becoming something that is an opportunity to buy at a better price. So I'm reconnecting my charger, hoping I didn't lose my connection. All right. So this is what we're experiencing with the Spanish 35 IBEX. So a very strong bounce here. So if you look at the price action between these two candlesticks, you can see the two tails indicating strong rejection of lower prices. And now we're almost making a full recovery towards the market open. So the market open was right here, just before the open of the green candlestick. So it seems like the market is going for that 100% recovery towards 11,363. So for the Euro Stocks 50 cash index, we had almost perfect support. So market kept dropping, eventually got to this area, and immediately after it got to that area, notice how there was a very strong bounce, and now the market is strongly headed higher, meaning that this panic selling is being recovered immediately, similar to what happened with Berkshire Hathaway stocks yesterday after there was a big glitch and the stock had lost over 99%. But then by the end of the close, the stock had recovered and moved back upwards. So in this case, it seems more likely that the market could be headed higher. Without being overly aggressive, I would say the open of the day is a key crucial target. So in this case, I would be expecting that the market at least gets to the opening price at the beginning of the day before making further progress. So very strong reversal, and potentially if you break that area, then we head to this upper trend line. So there's still more room for upside momentum. So for the French 40 cash index, a very strong support area here. So if you're observant, you'll notice this area here. Then you'll notice the most recent low here. And then today's price action bouncing at exactly the same area. And now what we are witnessing here is a very strong momentum upwards. It has already recovered towards the open of the day. And now we could be looking at more price action with further upside momentum. Without being overly aggressive, there's still more room for upside. So in this case, I'll be betting on this area here, which was acting as the previous support which could be now turned into the current resistance, so around 8,034 price level. So for the UK FTSE 100 index, this is what we are seeing, a market that was facing resistance along this 4-hour line. So kept going down, and then we had the strongest bullish momentum towards the end of last week. So Monday opens, price heads higher, but then makes an immediate drop. And this was a major signal during our session on Monday. You can find that on my tweets or on FX Pesa YouTube. Then after the big drop here, the market played along before making a further drop. Then today, even a further drop before finding support around this area. So judging by the correlation we are seeing in in European equity indices, it seems more likely that the market could be headed higher. Right now, we are facing a key level test. So we are looking at this area here. So if I adjust for the high of day, so this was a support area. We can all see this area here. But then the high of day is also equally as important. This was the highest price we saw today before the market began the sell-off. So I expect at least this bullish momentum to sustain towards this high of day, which is similar to what the other European equity indices are doing. So for the German 30 cash index, also bouncing strongly from a key level support. So the expectation of a market correction might be ended if the market doesn't break below those supports. So from the most recent high to the low we saw today, it's about 2.94%. This doesn't qualify as a support. And having seen this double bottom, meaning that the market was unable to form lower lows, only indicates that the panic is over. And we could be seeing the markets going for a strong recovery with the German DAX expected to get back to the high of day, which is 18,587 for the day without being overly aggressive. So there's still more room for upside momentum. So that's it with the major US and European equity indices. And now we can cover a couple of other assets before we end the session. So one of them that we'll be looking at is the Hang Seng. I'll be trying to open the Hang Seng index here. So the Hang Seng index has been really struggling to make a bounce. So from the daily chart, we know it has been pretty strong, very strong momentum that broke an yearly resistance line. So this was an year-long trend line that was holding on pretty well before it was broken. Then we had a sequence of days that the market was pretty bullish, pulled back, and now seems to be struggling to make a rally. Then from the forward chart, if I remove this and this, so our idea at first, and this was 2 weeks ago, was that the market would find support here and bounce. So this didn't play out. The market kept going down. And now we have a very familiar chart pattern, and this is called an inverted head and shoulder. So it's often taken as a signal that the market has weakened and is unable to form lower lows. And in this case, it's often leads to a bullish momentum. So notice that this is the first head shoulder, this is the head, then the second shoulder appears here. So for those who are focused on technical price action patterns, then you know what this means. So once the market completes that pattern, you expect some form of reversal. So in this case, the key signal would be if the Hang Seng index breaks above the neckline. So the neckline is a little bit higher, around 18,541. Then in that case, we should be expecting a strong bullish momentum, but only if the price breaks above this area. So the way to set targets on such a play, you look at the depth of the head towards the neckline, and then you estimate the same price action above the breakout point. So which means we could be seeing a strong rally towards this area of around 19,050 price level. So JPY pairs have been very strong. So we know that the yen has been very strong today. So having made this bearish momentum on CAD JPY, So this has led to a big sell-off here, leading to the market testing this support. So immediately the market hit that support, we have seen the market bouncing again. And from the 50 minutes chart, you can see prices are really struggling to move higher. But then fundamentally nothing has changed. The JPY is still weak. So it makes more sense to buy these currencies against the yen, as we speculate that the yen is still weak and we haven't seen evidence of the Bank of Japan making an intervention. So there is a good chance that the market eventually pulls back upwards. So after the market broke the trend line here, notice that this was a major key level support. So it had this strong acceleration. And of course, there should be signs of people taking profit and the market making a reversal. So it's a position that might be worth considering. In this case, betting against the yen across different currency pairs. So you'd have to compare them yourself and find the one that is best fit. But then, judging by the strength of the dollar, I would also be considering USD JPY. So for USD JPY, we had this kind of loudspeaker formation or a horn. And now, eventually, the market made a breakout on Monday, pulled back and then accelerated further downwards. And now, looking at potential support areas, we had the bottom here after the first intervention at 154.521. So there's still more room for downside momentum, which implies that the market could potentially drop to this area. And then from here, we observe to see if there's signs of bullish entry. And then perhaps we'll see opportunities here. So for metals, we have seen this pattern play out time and time again. So while silver had been pretty strong for the better part of the last couple of months, we saw a double top formation here on the 4-hour chart. Eventually, the market bounced from here. I remember discussing this on Monday. So after the bounce, we had a rally and the market found resistance here and then dropped further downwards and broke the trend line. So in this case, when you have an M formation or a double top formation, your signal is for the breakout, the market to break below the neckline. That already played out early in the day. And as we all know, for any technical price action traders, whenever there is such a break, sometimes it's wiser to wait for the market to retest the breakout point before you can trade the continuation. And in this case, it's playing out perfectly, which means or indicates that silver might be headed for much lower prices. And now looking at past price history, we should be expecting some further bearish momentum. And I don't know this yet. Yes, there's this price action level. Notice that this was high and it's the current price. So if the market breaks below that, then there's also this area here, which was consistently working as a resistance and could be now turned into a support area. So now looking at the price action here, it seems more likely that silver could be headed for $28,746. But also you have to be careful. The candlestick has not yet closed, and we could be seeing an immediate reversal and price starts going up. So if we go back inside the range, then the target remains to the upper side, 32,276. But then if this plays out as technical as it appears, then it means only further bearish momentum. So for gold, we have seen several price action patterns playing out. So one of the key highlights we have seen in this range, and I'll try to remove all this noise or accumulated bias. So that it's clear for everyone that this is our new trend line working as the resistance, and our trend line working as support is somewhere along these lines. And what we are seeing as the current price action, it's more of an inverted flag. So if I was to think of this high versus this low as a big bearish momentum, then the market made the flagpole, and then this is the flag, and the market is just operating between the two trend lines. So in this case, we are on a current swing where the market is moving further downwards. So noticing the swings and how they shape very well. So if you're not already in a trade here, it doesn't make sense to make a market entry now. But the idea is that the price is moving further downwards, and the best entry points is always at the edges. So if the market gets to this area, this is where you look for a position. If it gets to this other area, this is where you look for a position. But for now, if you're already in the trade, we know that we're expecting further downside momentum towards this area on the lower trend line. So that's it for the day. Thank you very much, guys. Let's check the questions. If there's no questions, then we will end the session there. So what correlation does US indices have with the DXY? Because today, correlation didn't work out much, only level of inefficiency being filled. So first of all, the correlations have been broken for the last 2 years. So we haven't had a very strong correlation between the indices and the dollar index in the last 2 years. They have been broken for a majority of the time. I believe the key factor driving equity indices is the earnings and the performance of various stocks within the index itself. So for instance, if you're looking at the S&P 500, as we have mentioned, you look at the top 6 companies and how they have been performing and their level of contribution to the performance of the index. So if you know that top 6 companies are contributing 75% of the performance of the index, then it basically narrows down to the concept that if you study these top 6 equities and see how they are performing, then they will guide you on how you trade the index itself. So the earnings are having a much more impact than monetary policy, because 2 years ago we were expecting that if the US was to continue hiking interest rates and get them to, let's say, 5.5%, we were expecting that the market would eventually collapse due to the weight of high interest rates on the economy. But then we have seen that the job market has remained stable, almost at full employment in the US. We have seen GDP remain pretty strong. And as a result, companies have made record sales, especially stocks like Nvidia, Google, Microsoft. And as a result, the indices have continued performing well. So the indices are more linked to the individual companies behind the index than the monetary policy itself. So in this case, the monetary policy seems to be having a minimal impact on the indices, whereas the performance of the earnings of those stocks are having a bigger impact. And that's why a lot of investors right now are basically anticipating that Nvidia is driving the Nasdaq and the S&P 500. And if it doesn't perform well, and then also you notice that the other indices are not doing well. So I hope that answers your question. This was from Litro Nyumbani. So what's your opinion on silver, bullish or bearish? So long term, I'm very bullish on silver, but right now, from what we can see from the price action in silver, it's nothing promising. It's just screaming for that bearish momentum. I think I didn't even finish doing this before the market shot further downwards. So there's still more room for downside momentum, having broken this trend line. So breakout, retest, continuation only means one thing. So we expect further downside momentum with a target around 28.746. And thank you, Patrick, for the question. So I'm seeing a comment from David saying he's a novice. So kindly check out the Novice to Pro course available on FXPesa YouTube. Go through it. It's 10 episodes. It will really help you understand a lot of content that I am presenting here, as well as the usual sessions that we do Monday to Friday at 11 a.m. So if you're just new to these sessions, know we have live sessions happening from Monday to Friday on FXPesa YouTube at 11 a.m. And we cover a lot of content impacting the markets. And these can help equip you to approach the trading day from a more informed perspective. So you might share an idea that you had not thought before, a chart you had not seen before, and hopefully you get to take advantage of that. Good comment from Tina. Working with trend lines is one of the best things I've learned from you. Thank you very much, Tina. It's something I've been using for years. So thank you very much, guys. Thank you for your time, and I hope to see you on the next session. So remember, if you're watching this on X or Twitter, remember to like and share the live session. If you're watching this on YouTube, remember to like, subscribe, and of course, share with other peer groups. And as usual, if you are just beginning your trading, check the links in the comment section below and create your live trading account or a demo trading account, then begin your trading journey. So thank you, guys. I hope to see you on the next one.